In the last 48 hours, silver just experienced one of the most violent price swings in modern commodity history. The metal hit an all-time high of $93.75 per ounce on Wednesday, January 15, 2026. Then it crashed 7.3% in a single trading session, dropping below $87 before recovering to around $89. That's a $6.50 swing in hours. $5 billion evaporated from silver markets. And here's what makes this absolutely critical. This crash has nothing to do with the fundamental forces that drove silver up 200% over the past year. The supply crisis just got worse, demand just got stronger, and analysts at Citigroup, Goldman Sachs, and BNP Paribas are calling for $100 silver by March, potentially $110 by mid-2026. If you're not paying attention, you're missing the setup for one of the most explosive commodity trades of the decade. As of Thursday evening, January 16th, silver has already recovered to trade around $89 to $90 per ounce, according to Trading Economics and Bloomberg. The iShares Silver Trust ETF closed at $81 ARS2, up 0.86% from the previous day. This isn't a market collapse. This is violent profit-taking triggered by a single policy announcement that changed absolutely nothing about the structural supply deficit. While traders panic sold on headlines, the physical silver market is tighter than it's been in decades. COMEX registered inventories have plummeted over 70% since 2020. China just restricted silver exports starting January 1st, limiting exports to just 44 approved companies. And retail investors poured over $920 million into silver ETFs in the past 30 days alone, marking an all-time record according to Reuters. Here's what actually happened. On Wednesday, January 15th, President Trump issued a presidential proclamation under Section 232 regarding critical minerals. Markets had been expecting sweeping tariffs on silver, platinum, and palladium. That expectation drove silver from around $61 per ounce at the end of December to $93.75 in just 2 weeks, a 53% rally in 14 days. But Trump didn't impose immediate tariffs. According to the White House fact sheet released January 14th, he directed negotiations with trading partners over the next 180 days. The proclamation stated the administration would promote the adoption of price floors for trade in processed critical minerals. No immediate tariffs, no quotas, just negotiations. The market reaction was brutal. According to ING Think's analysis, silver fell more than 7% on Thursday, retreating from that all-time high as tariff threats receded. Bloomberg reported the metal fell as much as 7.3% before recovering. Kitco News confirmed extraordinary volatility after silver had risen 30% in early January. Traders who bought purely on tariff speculation dumped positions immediately. Algorithmic trading triggered stop losses. Leveraged futures got liquidated. Classic, buy the rumor, sell the news, except the news was that there was no news. But here's where most analysts are missing the bigger picture. Trump's proclamation wasn't a retreat. It was strategic escalation confirming silver's critical importance to national security. The Section 232 investigation found that imports of processed critical minerals and their derivative products threaten to impair national security. The White House explicitly states, President Trump recognizes that processed critical minerals are indispensable to almost every industry, including national defense programs and critical infrastructure. Silver is now officially classified alongside rare earths, lithium, and cobalt as a strategic national security resource. Think about what that means. The U.S. government just confirmed silver is no longer just a precious metal or industrial commodity. It's a weapon, it's leverage, it's geopolitical power, and America is dangerously dependent on foreign sources, particularly China. The White House states, despite increasing demand, critical mineral production in the United States has been declining. The proclamation warns that weakened domestic production affects advanced weapons systems, energy infrastructure, and everyday consumer goods while making America vulnerable to exploitation by foreign actors. Now connect this to what China is doing. On December 30th, 2025, China's Ministry of Commerce announced new export controls on silver effective January 1st, 2026. According to Reuters, only 44 companies will be allowed to export silver over 2026-2027. 44 companies. China moved from quotas to a whitelist system, giving Beijing complete discretion. CNBC reported the new rules also restrict tungsten and antimony, materials dominated by China and widely used in defense. This is resource nationalism. China is weaponizing critical mineral supply chains. China produces a significant portion of global refined silver. By restricting exports, China is squeezing global supply precisely when industrial demand is exploding. According to industry sources, Silver industrial demand reached 689.1 million ounces in 2025, a record high. The three big drivers, photovoltaic demand for solar panels, electric vehicle manufacturing, and electronics for AI hardware and data centers. The Silver Institute forecasts the global deficit will persist in 2026, continuing a 5-year structural shortfall. Mine production remains flat because silver is primarily mined as a byproduct of copper, lead, and zinc. You can't just turn on more silver production. Supply is fundamentally inelastic. So we have China restricting exports, the United States declaring silver a national security priority, industrial demand at record highs, and COMEX inventories depleting at an alarming rate. According to January 2026 data, COMEX registered inventories have fallen over 70% since 2020. On January 7th, CME reports showed 3.25 million ounces withdrawn with zero received. A Seeking Alpha analysis noted an unusual COMEX trend signaling an accelerating silver squeeze. In the first week of January, holders of 1,724 contracts received delivery of 8.1 million ounces. Actual physical delivery, not paper settlement. The physical market is draining. Meanwhile, retail investors are steering record cash into silver. Reuters reported on January 15th that the iShares Silver Trust recorded $69.2 million in retail inflows on Wednesday, the largest day since 2021 when Wall Street bets tried to squeeze silver. Over 30 days through January 15th, retail traders funneled over $920 million into silver-linked ETFs. That's the biggest retail buying spree in history. These aren't institutional hedge funds that pivot on a dime. These are individual investors allocating retirement accounts into silver, and they're not selling on a 7% dip. This creates a fascinating dynamic. Paper silver, futures contracts on COMEX, experiences extreme volatility driven by algorithms and leverage. Physical silver, actual metal in vaults or consumed by industry, experiences relentless demand and shrinking supply. Goldman Sachs published analysis noting silver is entering 2026 with unusually thin inventories that could exacerbate price dynamics. The bank warned silver faces extreme price swings because low inventories make prices extremely sensitive to investment flows. With so little physical metal available, small shifts in buying or selling move prices violently. And the analyst forecasts are stunning. Citigroup raised its near-term silver target to $100 per ounce by March 2026, potentially $110 by mid-2026. According to goldsilver.com and Kitco, Citi's strategist team, led by Kenny Hugh, sees silver outperforming gold as precious metals broaden into industrial metals. BNP Paribas forecasts $100 as possible by year-end 2026. Goldman Sachs projects silver in the $85 to $100 range, viewing it as a core beneficiary of green transition due to its role in solar power, electrification, and AI hardware. Even HSBC, notably more bearish, expects an average of $68.25 for 2026, still 24% higher than late 2025. What's driving these forecasts? Silver's industrial applications now account for over 50% of total demand. Solar panel manufacturing consumed over 200 million ounces in 2025, representing roughly 30% of industrial demand according to Oxford Economics, up from just 11% in 2014. Global solar installations are accelerating as countries commit to renewable energy. China, the US, India, and Europe are massively expanding solar capacity. Every solar panel uses silver paste for photovoltaic cells because silver has the highest electrical and thermal conductivity. There's no perfect substitute. Yes, researchers are working on copper alternatives, and Business Insider reported solar makers are looking to substitute copper as prices hit records, but that takes years to implement at scale. The industry is locked into silver consumption near term. Then there's electric vehicles. EVs use roughly twice as much silver as traditional vehicles because of electronic components, battery management systems, and charging infrastructure. Global EV sales are projected to grow substantially through 2026 as automakers transition fleets and governments mandate electrification. Every Tesla, every BYD uses silver. Add the explosion in AI data centers. Training large language models and running AI applications requires massive computing power. Servers, chips, circuit boards, all using silver. As AI deployment accelerates globally, demand from this sector is growing exponentially. Here's where the supply-demand imbalance gets extreme. The 2025 World Silver Survey by the Silver Institute shows the global deficit persisted, continuing a 5-year structural shortfall. Mine production remains flat. Why don't mining companies produce more if prices are at records? Because roughly 70% of silver comes as a byproduct of mining other metals, primarily copper. Silver isn't the primary target. So even if silver hits $100 or $150, you can't significantly increase supply unless copper prices also justify new mines. And new mines take 5 to 10 years from discovery to production. Supply response is incredibly slow. The market is structurally short. Demand outpaces supply by roughly 100 to 200 million ounces annually. That deficit comes from above-ground inventories, stockpiles in warehouses, but those are rapidly depleting. COMEX inventory is down 70%, China restricting exports, retail buying physical coins, industrial users securing long-term contracts. Every month available silver gets smaller. It's musical chairs with fewer chairs each time. The gold to silver ratio is signaling something important. This ratio measures how many ounces of silver by 1 ounce of gold. Historically, it's averaged 50 to 60. In April 2025, according to goldsilver.com, the ratio sat above 100 to 1, meaning silver was massively undervalued. As of mid-January 2026, multiple sources report the ratio has pulled below 51, a level last seen in 2012. According to ISA Bullion's January 15th analysis, this is historically significant. When silver outperforms gold this dramatically, it signals extreme optimism about industrial demand or silver catching up after being undervalued. Probably both. Now let's talk about what Trump's tariff reversal actually means going forward. Most analysts are getting this wrong. The market interpreted lack of immediate tariffs as bearish because it removed the artificial supply shock traders bet on. But look at what the administration is doing. They're negotiating bilateral agreements with allies. The White House mentions Trump secured critical minerals agreements with Argentina, Australia, Cambodia, Japan, Malaysia, and Saudi Arabia. These agreements aim to diversify global supply chains and reduce dependence on adversarial nations, obviously meaning China. The strategy isn't tariffs, it's building an alternative supply chain that bypasses China entirely. Think about implications. If the US and allies successfully create parallel supply chains for critical minerals, including silver, it means massive investment in new mines, refineries, and processing facilities. That investment takes years to bear fruit. Meanwhile, China still controls huge portions of global supply and has now restricted exports. So China is squeezing supply on one side, and the West is scrambling to build new supply on the other. Who wins? The metal itself, the spot price. During the transition period, which could last 5 to 10 years, the deficit only worsens. Industrial users in the US and Europe will compete for limited supply, bidding up prices. China will prioritize domestic needs, exporting less. Investors will hoard physical metal. It's the perfect storm for a sustained bull market. There is one significant risk: silver thrifting. According to Seeking Alpha analysis from January 15th, some analysts expect silver demand to peak in 2026 as thrifting takes hold due to high prices. Silver thrifting occurs when industries use less silver or substitute cheaper alternatives. Solar manufacturers are researching copper-based alternatives. If copper can replace silver in photovoltaic cells without reducing efficiency, that could eliminate 200 million ounces of annual demand. Electronics manufacturers might also use thinner silver layers or cheaper conductive materials. However, here's the counter-argument. Substitution takes time. Research, testing, retooling manufacturing, regulatory approvals. Even if technology exists, implementing it at scale takes years. Meanwhile, solar installations can't stop. EV production can't stop. AI data centers can't stop. Silver keeps getting consumed. Even if demand peaks in 2027 or 2028 due to substitution, we could see 18 to 24 months of extremely tight supply and rising prices first. By then, silver could be trading at $120 or $150, still representing massive gains from current levels. The other risk is recession. If economic growth stalls, industrial silver demand would decline. That's particularly true for discretionary purchases like EVs and electronics. A severe recession could cut industrial demand by 10% to 20%, easing the deficit and pressuring prices. But in recession, central banks typically cut rates and implement quantitative easing, making non-yielding assets like precious metals more attractive. We saw this in 2020. The pandemic caused a brief crash, but silver rallied from $12 in March 2020 to nearly $30 by August as investors sought safe havens. Even recession isn't necessarily bearish for silver. It just changes the narrative from industrial demand to monetary debasement. Let me walk through what could happen over the next 3 to 6 months based on current information. Near term, silver will likely remain volatile. You could see pullbacks to $80 or even $75 as traders take profits. but every dip is likely bought by physical investors and industrial users securing supply. The $85 to $95 range seems reasonable for the next few weeks. Then, moving into February and March, several catalysts could push silver higher. First, more data on COMEX inventory levels. If inventories continue draining at the current pace, it could trigger another squeeze. Second, China's export restrictions will start to bite. Companies that relied on Chinese supply will scramble for alternatives, bidding up global prices. Third, retail investor interest could accelerate. If silver breaks above $95 and holds, it could attract momentum traders and trigger FOMO similar to Bitcoin or GameStop in past cycles. By March, if Citigroup's forecast is correct, we could see silver test $100 per ounce. That's a psychological barrier that would attract enormous media attention. Silver hits $100 would be headline news everywhere. That publicity could bring in a fresh wave of retail money, pushing prices even higher. Citi's most bullish scenario sees $110 by mid-2026. Goldman Sachs, while more conservative, still sees potential for silver to outperform gold throughout the year. The key question is whether industrial demand holds up. If economic data remains strong and solar installations continue growing, the bull case stays intact. If we see recession signs or significant substitution, that's when you'd reassess. Now let's talk about what almost nobody is discussing, and this is pure speculation, but worth considering. What if Trump's real play isn't about tariffs at all? What if the goal is orchestrating a controlled increase in silver prices to incentivize domestic production? If silver trades at $100 or $120, suddenly mining projects uneconomical at $25 become wildly profitable. Companies will rush to open new U.S. mines. Refineries will get built. The entire domestic supply chain could be rebuilt in a few years, funded by private capital chasing high prices rather than government subsidies. Trump gets to say he brought critical mineral production back to America without spending taxpayer money. The market does the work for him. If that's the strategy, the last thing Trump wants is to cap silver prices with tariffs or quotas. He wants prices to rise enough to make U.S. production viable, but not so fast it crashes the industrial economy. That's why you negotiate price floors with allies. You create a controlled environment where silver trades in a range that's high enough to incentivize supply, but stable enough not to disrupt manufacturing. It's economic engineering on a grand scale. And if I'm right, it means the Trump administration is actually supportive of higher silver prices, not opposed to them. The tariff reversal wasn't a retreat. It was a tactical shift to a more sophisticated approach. Here's what you need to watch over the next few weeks. First, COMEX inventory data, published daily by CME Group. If registered inventories drop below 30 million ounces, that's a critical threshold that could trigger a squeeze. Second, announcements of new bilateral critical minerals agreements between the U.S. and other countries. Each new agreement signals the alternative supply chain is taking shape, which is bullish long-term. Third, monitor retail ETF flows. If the $920 million that flowed in over 30 days continues or accelerates, it means retail investors aren't deterred by volatility. They're buying the dip. Fourth, watch industrial demand data. The Silver Institute will release updated figures in coming months. If photovoltaic demand continues growing at double-digit rates, that confirms the bull thesis. If we see signs of substitution or demand destruction, that's a warning signal. Fifth, pay attention to China's export data. If Chinese silver exports drop significantly in Q1 2026 compared to previous quarters, it means export restrictions are having real impact, tightening global supply further. Finally, watch the gold-to-silver ratio. If it continues compressing below 50, it means silver is dramatically outperforming gold, historically a sign of a powerful bull market in both metals, but especially silver. If you're finding value in this breakdown of what's really happening in silver markets, hit that like button. This kind of deep analysis takes hours of research, and your engagement helps me keep creating content that goes beyond surface-level headlines. I'm not trying to pump silver or tell you to buy or sell. I'm giving you the actual facts and competing narratives so you can make informed decisions. What's the contrarian case? What am I potentially getting wrong? The main counterargument is that prices have already run too far too fast. Silver was at $30 a year ago. It's at $89 now. That's a 196% gain, according to Trading Economics. Markets that move that far typically experience significant corrections, often giving back 30% to 50% of gains. If silver follows that pattern, you could see it fall back to $60 or even $50 before stabilizing. That would shake out leverage traders and retail investors who bought at the top, creating a healthier base for the next leg higher. But it would be painful for anyone who bought in the 80s or 90s. The other contrarian point is that precious metals bull markets tend to be driven by fear and crisis. if geopolitical tensions ease, if inflation moderates, if central banks don't cut rates as expected, the safe haven bid could evaporate. About half of silver demand is still investment in jewelry, not industrial. If investors rotate out of commodities back into stocks or bonds, silver could fall regardless of supply-demand fundamentals. Markets don't always behave rationally short-term. They can stay irrational longer than you can stay solvent. But here's what gives me confidence in the longer-term bull case despite those risks. The structural supply deficit is real. It's not theory or projection. It's showing up in data. COMEX inventories depleting, Chinese export restrictions, retail buying at records, industrial demand at all-time highs, mine supply flat. These are facts, not speculation. When you have a genuine supply shortage in a market as critical as silver, prices tend to adjust upward until demand is destroyed or new supply comes online. We're nowhere near demand destruction yet. Solar installations are accelerating, EV adoption is growing, AI build-out is in early innings, and new mine supply won't hit the market for years, even if companies start investing today. So you have a window, probably 12 to 24 months, where the deficit keeps widening before substitution or new supply can catch up. During that window, prices have significant upside. How high? Nobody knows. Citigroup says $100 to $110. Some bulls call for $150. I've seen forecasts of $200 if there's a genuine short squeeze. Bears think $60 to $70 is more realistic once speculative froth comes out. The truth is probably somewhere in between. But what seems clear is that silver is no longer a sleepy backwater commodity. It's become a strategic asset in great power competition between the US and China. It's critical input for energy transition, and it's a potential safe haven if the global economy hits turbulence. This situation is evolving by the hour. Subscribe and turn on notifications so you don't miss emergency updates if there are major developments in silver markets, Trump's tariff policy, or China's export controls. I'll be covering this story closely because it sits at the intersection of geopolitics, monetary policy, and technological transformation. These are the kinds of macro trends that create generational wealth if you position correctly. The U.S. Mint issued a warning on January 12th that it may temporarily remove silver coins from sale as it evaluates pricing adjustments due to silver hitting record prices above $90. The Mint is struggling to source enough silver to meet demand for American Eagle coins. When government mints can't source physical metal, that tells you something profound about how tight this market really is. The paper price on COMEX can be manipulated with futures contracts and leverage, but physical metal doesn't lie. Either it's available or it's not, and increasingly, it's not. So what do you think happens next? Does silver consolidate in the $80 to $95 range and then break higher in March as Citi predicts? Does it crash back to $60 as bears expect once speculative fever breaks? Or does something completely unexpected happen, like a short squeeze, sending it to $120 in weeks? Drop your prediction in the comments. I'm genuinely curious what this community thinks because the range of outcomes is unusually wide right now. Here's my bottom line on this whole situation. Trump's tariff reversal was not the death of the silver bull market. It was a tactical shift in how the United States plans to address critical mineral dependency. The fundamental drivers, supply deficit, industrial demand, geopolitical tensions, remain intact and are intensifying. The crash from $93 to $87 was profit-taking and stop-loss liquidation, not a change in underlying thesis. Silver has already recovered most of that decline. Institutional analysts remain bullish with targets of $100 or higher. Retail investors are pouring record cash into silver ETFs, and the physical market is tighter than it's been in decades. Does that mean silver goes straight up? Of course not. We could see significant volatility, pullbacks, and consolidation, but the trajectory over the next 12 to 24 months seems more likely up than down based on current information. The key events to watch are COMEX inventory levels, Chinese export data, industrial demand figures, and any new policy announcements from the Trump administration. Those will tell us whether the bull case is playing out or falling apart. What do you think happens next with silver prices? Are you buying the dip, selling the rally, or staying on the sidelines? Drop your prediction and reasoning in the comments. And if this analysis helped you understand what's really happening beyond the headlines, share this video with anyone trying to make sense of commodity markets right now. The silver market just gave us one of the most dramatic reversals in recent history. The question now is whether this was the top of a speculative bubble or just the beginning of a much larger structural bull market. Based on everything we've covered, the supply-demand fundamentals, the geopolitical tensions, the industrial demand growth, I'm leaning toward the latter. But markets have a way of surprising everyone, so stay alert, stay informed, and make decisions based on facts rather than hype. Thanks for watching.